So our next panel discussions topic is Lend, Repent, Collect, time to focus on collections even before disbursements. Well, the panel members are Mr. Ashish Goyal, co-founder and CFO, FIBE India, formerly Early Salary, Mr. Ajay Thomas John, Group Chief Digital Officer, CDO from Shriram Capital, Mr. Sabyasachi Senapati, whole-time director at Trillion Loans. May I request our panel members to join us on stage? The session will be moderated by Mr. Winny Patro, co-founder and CEO of Recordent.
Good afternoon, everyone. I think we're good to go. Maybe we'll quickly start with an introduction. Each one of us will take a quick 30 seconds, each one of us, and then we'll get into the topic. Sabyasachi, you want to start off with?
Hello. Yeah, hi. I'm Sabyasachi. I represent Trillion Loans. Trillion Loans is a NBFC, which is part of BharatPay Group. We acquired it around April of last year. And the focus is, a lot of the focus is on doing loans for SMEs, merchants, though the product portfolio is quite diversified. And quite excited to be here and lead a meaningful discussion.
Hi, I'm Ajay. I lead digital transformation for the Shriram Group. So I'm part of Shriram Capital, which is the holding company for Shriram Transport Finance, Shriram City erstwhile, which is now Shriram Finance, which has merged. Shriram Life and Shriram General, Shriram AMC, and Shriram Housing Finance as well. We've also got a tech arm, which is called Novak Technology Solutions. So I represent the group for transformation solutions.
Hi, my name is Ashish Goyal. I'm co-founder of FIBE. Earlier it was known as Early Salary. We are a consumer lender. We provide financing to the mid-income aspiring individuals. We are based out of Pune, and everything is we are a lending fintech.
Right, my name is Winny Patro. I run a fintech SaaS for small and medium enterprises to manage their credit to cash cycle. So today's topic, I think we'll kickstart. I think as they announced collections before lending, I think it's quite an oxymoron to put it in that way, I think. But the idea is to sort of discuss how collections has rather been a challenge for a very long time and how things have sort of progressed, and also the point at which you bring in the strategy or integration of collections in the cycle of lending. So we'll start with the Sabyasachi, Trillion Loans. Sabyasachi, I think you represent sort of a new age lending platform, right? And you see the transformation that is taking place in the fintech landscape, and there is a rush and there is competition among the fintech lending players to give out more loans, and obviously everyone has to perform and everyone has to thrive. On the other side, there is always a risk of collections, and there are people, there are so many fintech players around. Is it going to sort of become a bubble over time? Are there proper checks and balances? So you being in the field for some time and now starting off with Trillion Loans, what has been the observation from your side on the transformation that's taking place and the new rush with lending, especially with respect to the risk taking, risk assessment while lending and the post challenges NPA? Yeah.
So see, I think if you see over the last few years, the way fintechs have grown and the key value add for fintech, right, in this space has been to improve access and reach in some ways, right? So, it's a sort of an overused statement that, earlier a large part of our population used to be underbanked, right? Your banking penetration improved over the last couple of decades or so. But we still see that a significant part of the population doesn't have access to formal credit, right? Or credit at a certain appropriate terms. So that's where I think fintechs have come about, where they have improved both reach, where certain segments, for example, In case of Bharatpet has been the Kirana stores, the small merchants, right? Plus, in terms of not just reach, but also access in a proper way at a certain time, at a proper time, right? I think that's the value that has come about. And the way it has panned out is, obviously now there are fintechs in each and every segment across retail, SMEs, business that you look about. The way it has come about is because, you have some kind of a solution or product in the market around which credit is built. And that product has given you access to certain data, which has helped in better underwriting, or it has given access to a certain channel which has helped you both sell and collect, right? So again, taking the example of BharatPe, right? We were a payment-first product. Core product was a QR, your simple plain vanilla QR code, which we used across the merchant network of the country. Now, the difference was the QR code that we first launched was a interoperable QR. So the same QR code could be used across a range of UPI enabled apps and not restricted to a certain platform. Once you build the network, essentially what happens, you have a QR code basis which you have access to transaction data, and you are using the transaction data to underwrite. And basis that you are able to lend to the merchant, right? So one, you have access to certain data, which otherwise if you did not have that, typically any other bank or NBFC may or may not have access to certain data, right? And you can do a bunch of analytics around it in terms of what's your trends, what kind of transactions are proper versus not, etc., etc. The second is because you have that same QR, it gives you the ability to collect once you've given out a loan, your ability to collect your repayments through the same transaction that is generated, it increases, right? Now, because of this, the cost of processing a loan and the cost of collection is significantly come down, right? If you have to depend on more conventional methods of either underwriting, in which case most of them may or may not have the right kind of access or to the right product, or if you were dependent on a more conventional method of collection, then the cost of collection itself, and here we're talking about a ticket size of, let's say, 70 to 90,000, typically 80,000 odd ticket size, the cost of collection would have become very prohibitive, right? So this is where, you have a certain product or technology which has given access to you for in terms of data and channel, and that has helped you underwrite better and collect better, right? So here, in some ways, you're just going back to the theme, your collection is very closely connected to how you've done the underwriting or what method you've used for underwriting, right? It cannot be seen in isolation.
But in this case, I think it's very sort of proprietary to your own Trillion loans because you come from the family of BharatPe, right? The Trillion loans is part of the family of BharatPe. But in a case, if I go to Ajay, so he, the Shriram Capital, you're part of the digital transformation. What Sabya was mentioning about the underbanked and, it's just a similar segment that you operate, right? This is what my understanding is. Now, obviously, for you or for Shriram, access to such data, what Sabya is talking about, is something not easy, right? And how much is still you see the scope for so much of this hybrid dependency to get into digitalize or moving towards digitization? Do you foresee that's happening very soon, especially on the credit assessment side? Or actually, for the audience sake, you maybe touch upon how the credit assessment still happens in your segment.
All right. To put things into perspective, what we've been talking about is customer segments across different parts of India, right? When I look at dividing India, you're talking about typically dividing into 5 Bharats. When I talk about 5 Bharats, companies which are more fintech are operational in the first 3 Bharats of India, not in the bottom 2 rungs, where there's a lot of financial inclusion which is possible, right? Now, when you look at data which is available, I would like to segregate that into more as to the nature of products that we function in. So we are a company which operates right from heavy vehicles, starting from our commercial vehicles to your light vehicles and things like that, right? When you have so many variants of customers where identifying the income of a customer itself is a challenge. You really do not have enough data to substantiate. There are also enough customers who are working on different working capital solutions as well. Then you got another segment. We are also one of the largest two-wheeler financiers in the country. We've done, to be precise, 1.3 crores of two-wheelers to be financed in the country. Now, when you're talking about that kind of a two-wheeler loan being funded, 52% of our portfolio today are new to credit customers, which means they've never been tested. How do you look at giving credit to any of these customers? What is the opportunity which is available?
They don't have credit score at all.
Absolutely no. So what's the point of even hitting a bureau to get a zero bureau score, right? I mean, doesn't make any sense. So, and what are the profile of these customers? What kind of income segments are we looking at over here? It varies from people who are basically farmers and other stockists and other basic SMEs who are running, or it could be even your mom and pop shops. Right? So these are customers who are trying to get their first two-wheeler out of for their children, and you try to evaluate credit. So while there is a creme de la creme segment which is available, which is all can be done straight through, which is an unsecured personal loan, for example, or an unsecured business loan, which is GST filed and things like that, there is still a larger population of this segment existing in the market. And when we look at catering for this particular segment, we see an opportunity of not just, using digitally verified data. Even the traditional models of even visiting a customer's residence still exist, right? Otherwise, you would never be able to understand what is the possibility of giving this loan to a customer who could actually scale potentially, and what kind of relationship we look at holding. But the good thing is when you evaluate these customers, and especially in that particular segment, there is a good touch of repayment which is available. You don't have loans, a lot of loans going into bad books. You are still able to control what your delinquencies are. It's a huge opportunity that we look at, looking at sensitizing and closing. So there's no point in keeping this segment away at all if you really need to scale a business product as such. That's what we operate on, and a lot of the automation on this front works on platforms where you can go into a hybrid model, punch in an application, and then look at, identifying what are the models which are available, so that tomorrow you can use it as centralized underwriting models also if you want. So that documents are uploaded, photos are uploaded, and then you go ahead. That's how this segment operates. Whereas a salaried personal loan typically goes through the same paperless processes. You really do not know. You do not need to even visit a customer if you've got your geotagging up and running and things like that, right? So we've got products of extremes. That's the typical nature.
Have you ever sort of tried to analyze the behavior, especially in the case where your team is going to the borrower's place, right? And they know where he lives or she lives, the locality, all of that. Have you seen in such cases, your collections are better because they know for the fact, okay, Shriram Finance Company guys know where I live, right? And is there a sort of a consequential factor in their mind in it to rather, not have defaults or not to get an NPA versus the digital journey per se, because I'm sure you also have certain digital journeys in place. Yeah.
Okay. So in terms of experience, right, what customers also kind of sense is that this concept of lending is called relationship-based lending for us. We are not, especially on the commercial vehicle side, we are not stopping to lend only just one customer, one truck, right? We've got customers in our segment who've gone on to purchase as high as 58 trucks to 60 trucks. Right, so those are the segments of customers who are there, and it's a relationship which has always worked. And the flexibility to also repay, and the way he would want to pre-course his loans, how does he open up a new relationship, what are the cross-sell products which are available for him to take up, also works a superior thing. So it's while I would say that is the only segment which is closer to banking, I would say, which is about relationship management within the ecosystem. The rest of it is all direct consumerized lending.
Yeah, no, why I'm saying, I think in our experience, when we observed, especially those loans or defaults that happened actually during COVID, and most of them they run small stores and small shops. They run out of the businesses what they were running during that point of time. They're sort of bankrupt and all of that, right? So they change the place of business. They're no more in that place. Even after that, you send a physical teams for recovery and all of that. Then nobody exists and all of that, and these guys have taken loans in the credit completely through digital, means, and they've never met anyone from the lender, right? And here are the cases where in your case, and I think it's very different, where somebody is actually going, the relationship that you're talking about, it's a it's not an online or a virtual relationship per se. So which is where I think though it's a traditional, but I think it's sort of a better integrated.
So I would say we have three models in place. One is pure online. Second is online to offline. The third is offline to online. Right. So these three models put together is what we function as an organization, and that's why we are able to cover base. So irrespective of the channel that you come on board, you get him onboarded onto some platform, and then you look at how do you manage this relationship up.
Thank you. So when you mentioned there are so many out there who do not have credit scores, and all the first time the borrowers, right? And the segment that you're catering is the, let's say, completely not bottom of the pyramid, but towards that end of it, right? Similarly, have you seen them, the young population, like for example, early salary, if you talk about the Shriram caters to such young population, or it's just the bottom of the pyramid or the entrance into the economy?
No, we do have a young population on board, but that is again depending on the segment of the customers you're talking
Yeah, of course.
about. Age, our entry age for any product is around 24.
Oh,
right?
that's interesting.
It's not that anything before that. But at the same point of time, it's the young population which is also coming up from which rung of the Bharat which you're talking about, right? You still don't. If you look at for the elite, we've got fixed deposits. That's the only product which we serve for the elite customers, right? Beyond that, it's all lending basis, whatever financial inclusion products that we have, and what are the markets which we want to be operating on. So I think in our priorities, the group has been very clear in terms of, what is the segment that we need to be lending and what we need not be focusing on. The biggest strength and the advantage which we think we have is our distribution of a branch network. We have 3,500 plus branches which are across India. And name the town and the city, we are almost there. And within a 25-kilometer radius, if we are able to
quite a
cater
fleet
and service, I think that's a functionally
your
scalable
fleet on
model.
street is quite strong. Yeah.
Correct. We've got 75,000 plus employees on Shriram Finance.
Yeah. Thank you so much, Ashish. I think it's probably the statement collections before lending rather fits a lot better with early salary. Can I say so? Because you know and you have the control of sort of detecting the loan that was given. Is that how I can probably put it?
So any lending, there is always a point that are you a lender or are you a collector? Most of the time you will always hear people say that we are not in a business of lending, we are in business of collections. I believe we are business of risk management. If you give money to a wrong set of people, however strong your collections are, you can't collect it. So the risk management starts when you give the money. So like classically, when I started my business, my mentor told me one thing, that your leverage ends the day your money goes from your account to the customer accounts. And then the customer has a leverage to pay you back. No? And second is that generally speaking, if you take out the frauds, etc., 99% of the customers like to pay you back. That's a human behavior. So if you put both of them together, it's always very, very critical for you to keep it in mind and trust that the people willingness to pay you back is very high. There might be situations why they don't pay it. So if you have controlled at underwriting level, saying that what are the customers you are willing to accept, and especially when you are completely digital, unlike Shriram, and we work very closely with Shriram, and there is a very, very clear demarcations about the business models which you built. Now, whether you are first disbursing on the strength of collections, or are you collecting on the basis of on the basis of your disbursement? How strong your fraud mechanisms, how strong you have built your underwriting systems, and whom you want to really give money is very, very critical. The second, which works universally, is the risk-adjusted returns. See, you can run a higher NPA and collection cost, provided you are getting paid for it by the charging higher interest rates, right? Right, wrong, the business model exists across board. If you are charging low and your credit costs are higher, you are bound to fail at some point in time. So it is very, very critical to understand your business models and put it together, saying that what are the kind of underwriting mechanisms you put in, so that there is a acceptable bounces which happens, and then you have a right set of mechanisms to collect that money. Collection is a persistent business, and perseverance also plays out. It is every day's efforts. You need to remind the customers, you need to work with him very, very closely. you need to use your data sets to find out how do you really go and collect your money back. Because it's an integral part of running a financing business. So like today, just to give an example at our end, over last 8 years of our learnings, we have built strong data sets and capabilities which allows us to really differentiate between the set of consumers at the time of giving money while they are running their loans along with us. So we call it as behavioral science or behavioral economics and behavioral scores. And after that, once he defaults, you run collections. And you really need to segregate because like today, you will be collecting money from almost 50,000 customers after they have not paid their EMIs, and which you can't do a single fit for all size strategies to collect from 50,000 customers. So analytics plays a big role. The collection efforts are large. You need to mix it with your telecollections as well as on-ground presence, and you build an extensive network of agencies to collect your money back. Coming back to the question that whether you should worry about your collections before disbursement, yes. At the end of the day, you will make money only when you will receive your last EMI. You don't make money till the time the last EMI comes in, right? So as you more focus while building your technology around underwriting, your collections will be sorted. There will be events like COVID, which you mentioned. There will be spikes. There will be things will go out. But generally speaking, if your credit collection and the customer selections are right, the money comes back. We have seen many businesses delaying their payments for 6 months, but they came back and paid. So you need to focus on collection at every point in time, before disbursement, during the customer when he's paying on time also, and also after once he defaults.
Especially, I think the data which, like how BharatPe, Sabyasachi was mentioning, in your case also, I think the access to data beyond the credit bureau it sort of plays a very critical role.
Strong data points are there. Of course.
Because you also get into behavioral part of it.
We get into behavioral part. Again, it's a long relationships with the customer. It is not a one-time relationships. The customers keeps coming back to avail your products. So there is a lot of behavioral data gets built over a period of time. And also, when you operate on a homogeneous set of consumers, our ability to bucket the customers into the right segment becomes very strong. So at the end of the day, there are 10, 20 personas of the people which we have, unless you go and create 2,000s of them, which generally doesn't work. If you create 10, 20 personas, you can put the entire world into those 10, 20 personas. And how do you really do that well? So that whenever the customer comes in, can you identify and put that into one of the personas? And then run those engines for underwriting, for giving approvals, for maintaining those customers. So just to give an example, today when the customer comes to us, and if he's in our system for more than 3 months, we start generating behavior scorecards. Okay, and every behavior scorecard generation triggers a question to my team or to the system saying that, okay, do you want to continue to build relationship with him more? Which means that maybe you want to increase your limits, or you want to maintain what you are doing, or you want to discontinue your relationships. And you do this question, you ask these questions every month on the entire portfolios. So it is a day-to-day operations which allows you to manage your risk. Collection and disbursement both are a subset of risk. At the end of the day, beyond a point, collections can do that much only. No, it can't, means if the customer doesn't have money, you can't collect at a scale. See, you can do for 5, 10 customers, but when you give money to 1 million customers, the law of statistics will play out saying that if you have lent to bad customers, you will not get your money back. So the idea is to use those analytics every day and keep using them to ensure that you are on track for your numbers.
Yeah. In fact, taking that as a cue, in fact, Sabyasachi, you mentioned again from the perspective of alternative data, your lending is largely based on the transactions that have happened, through POS or through QR codes, right? Primarily through QR code. If I may ask you, what is the weightage of your data, or in your case, the credit bureau data is obsolete in terms of the weightage? How does it work in terms of the assessment, the weightage of your data against the weightage of the data that if there is a credit bureau score or the available on the particular borrower?
See, core part of the data is the transaction history on your QR platform. That remains the core. There would be other data points. Some cases there would be valid credit bureau data as well, or some other data points. Those are all go towards building better and better models. And the product construct would change somewhat. So for example, someone who would have additional data points, that person would qualify for, let's say, a higher ticket size or a slightly different product construct in terms of repayment and so on, right? But like I said, the core remains the transaction data on your platform. And there, obviously, there is a vintage. You would look at, let's say, at least a 6-month vintage, if not more. And there also, you will slice and dice it by segments, what segment of store this is, what kind of pin code and locality is the store. So there is a lot of other factors that goes into it, which are then overlain on top of the transaction data to build some kind of a underwriting model.
To understand the sort of a risk appetite or the model and the weightage of your transactional data, let's say in a credit bureau, if it fetches an NPA, right? Well, what does it exactly mean for you in terms of the decision making? Let's say one loan is NPA, of the borrower in the last 1 year. Now, where does it stand? Because is that going to be a very critical for you, though your transactional data is showing quite positive, and your demographic data, of course, you're collecting, that's also still positive.
Yeah, I think, see, what happens is, in our experience, we've seen, because, see, the segment which we look at, these are largely the unorganized retail segment, right? So therefore, these are typically your standalone neighborhood stores, right? And a lot of them may not have valid bureau scores, right? Wherever, obviously, see, the point is, in fact, to that extent, not having a bureau score sometimes is better than having a score,
that's exactly where I'm coming to, yeah.
Which is poor given some kind of a default history.
Right.
See, the point is you're also trying to see, both ability and willingness to pay, right? Now, if there is a default history, then there are questions on not just your ability, but on your willingness to pay. And essentially, see, a lot of times the ability to pay can be assessed in a certain way, with a fairly high degree of accuracy. Now, what I think Ashish was mentioning on the behavioral part, that is where you're getting more into saying your ability, your willingness to pay, even if you have that ability, right? And that, I think, obviously becomes very difficult to assess unless you have a lot of the repayment behavior of a similar customer or similar segment on your own platform, right? So there, obviously, if you have poor bureau scores or some kind of a DROC history, that goes against you, as opposed to, let's say, if you are an NTC and you don't have a bureau score.
I'll just add to it. When you look at bureau score at a scale, like when you look at millions of customers together, there is always a lot of, while at a scale it will show the right data, but there is always a noise in many of the few cases. Purely because, let's just take an example. I had a credit card, there was a 500 rupees charge, I just decided, kuch bhi ho jaye, nahi pay karunga. Now he's reporting 500 rupees and my bureau score is going down. But somebody else is giving money, I'm paying my home loans, I'm paying my credit cards, everything else is on time. Now many times when you run algorithms, that might get flagged and you might get rejected. So as you build your data, you start seeing those patterns into your data saying that, look, these are the set of consumers, while they might have a DROC on one of the lines, but there is a possibility that it's a good customer, right? That is what, in his case, he has payments data. In our case, we have similar set of consumers data of the past, which allows us to bucket that customer saying that, look, there is a one default, but other two lines are good.
So do you flag them differently? Let's say from a standpoint of futuristic collections?
Collection is separate. First, you need to give money to them.
Of course, you need to give money, so but when you give the money, so there are two cases you're talking about. So would you flag them?
Absolutely. See, anybody who gets segmented.
Like keep a tab on these people, because
absolutely.
there's
everything. I mean, you keep a tab on every customer.
Of course, right? You need to.
Whether it's a greatest quality customer so you look at every customers, because at the end you have flagged it into a particular bucket,
right?
At a particular segment. So you will go and check those segment performances every month and see that what are the bounces, what are the resolutions, etc., and work on those bases. So everything ultimately boils down to you to take can you sketch his behavioral pattern and put into a bucket, and at a bucket level, Does it has a acceptable risk? If it is acceptable risk, you go ahead and do the business. Otherwise, you just don't do the business, right?
Yeah. That's interesting. And you're talking about the past data. In fact, Ajay, you talked about 1.3 crore two-wheeler loans, right? I think that's quite a number. So majority of them, you're saying, they're the first-time borrowers. So obviously, they're getting into the credit bureau, the scores because you report to the bureau. But how much of that data, because you're also capturing the 1.3 crore loans data, not from a standpoint of how they're paying their EMIs or the collections and all of that, but I think it's very important. Very interestingly, you're actually capturing, going there and picking up their social profiles and demographics. Now, how much of this actually, helps retargeting, or rather, the data per se gets integrated in your strategy?
So, to put your question in perspective, right? I mean, while I mentioned about two-wheeler loans, which is 1.3 crores, our next biggest product is unsecured cross-sell PL on two-wheeler.
What is it?
Cross-sell PL on two-wheeler.
Okay.
Right? Now, you've identified customers, you identified numbers,
Yeah.
you understood data of these customers, you know the behavioral pattern of these customers, and then you look at, opportunities where you can further look at scaling up these customers into a different product that we would want to issue. The other piece is we've also walked in Shriram a journey about creating a super app. So we've just gone live. It's been within a quarter. We've just crossed our first million of downloads. And people have started engaging on every platform which is available. So what we also try to do is try to understand these customers better from the service requests that we can kind to get, the kind of investments or the kind of even behavioral data which we also get, right? And what kind of navigation does the customer going through a particular app? What are the preferential products which you would want to consume? So that's the direction which we're working on to understand this customer better and look at, other opportunities to fund customers. So what we work together is today a model which is typically a customer lifecycle model. What next best product can I offer to a particular customer? And what could be the right ticket size and what is the best price which I can offer for this customer? Well, it could be secured, it could be unsecured, it could be anything to do with an SME into the nature of business that he owns. So that's how the entire data piece is structured so that we'll be able to create more opportunities to engage and strengthen our relationship with the customer.
Got it. I mean, just to follow up to that question, I'm sure you would have, come across a lot of cases where the NPAs, after a certain point of time, they can come back, and borrow, right? And is there a sort of a model? This is for all three of us, but all three of you. But then I'll start with you. In your case or in the Shriram Capital case, how and when do you start actually looking at them back? Because of course the intensity is different for different NPAs. After NPAs, some might have gone to completely defaulted. Some might have sort of collected. Is there sort of any rule engine or sort of a structure built?
So again, I'll tell you, right? It is a call where we look at funding certain products into this particular case. I would never go and look at an unsecured product immediately for a highest defaulter, right? And again, there are ticket sizes which can be looked at, waived off, right? If there is an outstanding of something less than $5,000 or anything of the sort. But again, if I would want to look at a commercial vehicle segment, delays are quite possible. It is within the ecosystem, and that's how they function. The cash flows are arranged in that kind of way that people can always be. They're not like your salaried guys who get a 31st credit every month. Business. Things are completely depending on cycles and what the seasonality is looking like. And when the fund is needed is what we look at typically operating on, and then looking at creating more engagement opportunities. And that's the reason why that particular product is more physical in nature, and I would say more hybrid in nature compared to any of the other products. There's a lot of complexity in terms of understanding the businesses. Why? Because there are so many adjacencies next to a trucking business alone, like say for example, funding for fuel, right, or toll charges, right? These are all products which are there within the same ecosystem. Because you're talking about, I come from Chennai, so from Chennai to Vizag, a truck runs, you're going to fill fuel for at least $28,000. That requires a good working capital in itself.
Capital, yes.
Then you're talking about adjacencies like, even maintenance of a truck, what kind of expenses do I need to be putting in, what kind of precautions do I need to be taking for a truck, and what kind of a lifestyle do I need to manage for a driver in itself. So each of it has multiple advantages in that particular ecosystem, which we want to potentially tap in, and we try to understand that ecosystem much better. In our portfolio, we've got customers who started off as a cleaner and then moved on to, becoming a driver, who's graduated to a driver. And from there, one of our customers owns close to 50 trucks who came that path, right? And that's the model which we believed in, and that's pretty much scaled up the way things are happening, right? So a lot of data needs a lot of understanding about the business model.
That's right.
Right? You can't standardize. Every case is different.
Yeah.
It's unlike, like for example, I'm a big fan of unsecured credit. I can always look at, structuring it basis whatever things can happen, right? My past stint was that. Before I joined Shriram, I used to work for one of the leading unsecured credit companies in the country, right? So, but things are a lot different. You need to understand at a case level if you really need
definitely things are quite different and quite heavy in the market. So much is consumer driven today. The fact that I think the topic, if you talked about, why collections is becoming a centerpiece, or why it needs to be sort of integrated, if you look at it around. So this is, I think, first time ever. I mean, it keeps obviously keep going on and on, but I think first time ever India has seen so many people coming into the banking segment. Rather, started first time taking loans and coming into the organized credit bureaus and all of that. I think COVID rather accelerated also quite heavily. I mean, you're a classic example. BharatPe is a classic example how everyone starts using the UPI and so on. So with that, I think, is it a time, or are you guys back in your boardrooms looked at, okay, so there are going to be NPAs, and it doesn't mean it's the end of the road. It doesn't mean that we should look at traditionally, because once, I think, even until very recently, there are banks, who don't look at the NPAs at all. They're not going to encourage, and it's a big no. Or there's still very banks and traditionally run only on credit scores. But I think the models have changed quite differently now. How do you see that getting integrated completely at the credit assessment stage itself? It's, I think, and we're looking at scale quickly, right? Automation primarily, right? I think in Shriram case, it's very different because they've got quite a scaled fleet on street. But in your case, or in Trillion Loans case, it's quite different. How are you seeing these patterns evolving?
So you're right. Last 5-6 years, there's a slew of things which happened culturally, fundamentally in India, which led to a lot of people coming to the formal economy. Also, a lot of people getting the first-time credit access. Purely the amount of digital infrastructure which we have built, which I'm pretty sure we all know about it. The availability of data has made it, plus supply of companies like us, who has created that kind of a platform for people to access credit very easily. During this entire process, generally speaking, what happens is the customer looks at the money, and then you need to really figure out how do you really ensure that how does the segmentation of that customer works well. And that's from where your business model starts evolving, saying that how do you really go and lend to which set of consumers.
Got it. In your case, Sabyasachi, the same question goes to you.
Yeah. No, so a couple of things. One, when you mention about NPA, see, NPA is looked at a portfolio level, right? So obviously, then it depends on what is your tolerance in terms of at a portfolio level, what kind of NPA is tolerable versus not, right? And this is irrespective of whether the segment you're looking at, whether they have bureau scores or not, right? And I think then when you're getting into a new product or a new way in which you are underwriting and collecting, right, there is obviously a learning curve. For example, BharatPe, I think we've been doing this now just before COVID we started. Obviously, COVID was not the right time, but then after that, there's been good 4-year kind of vintage of the product and segments that we have done, in which case the underwriting has evolved, and basis a given underwriting, we are fairly, accurately able to estimate what would be the NP on that portfolio. And depends on, therefore, what kind of NP is acceptable at what point of time. You'll accordingly tweak your underwriting to either grow or not grow your business in some ways, right? So I think that's there. I think in terms of collection, see, like I said, because a large part of that is linked to your QR platform, right? As long as the merchant on your network continues using the QR platform, you are able to collect your installment, right? In case that fails, either because the transaction is not happening, now due to both reasons, it could be because the shop is not doing well, or there is an intention of not to pay and not to use the QR code and therefore not to pay, then you have a feet on street, which is largely your sales team who have engaged largely in sales to give some kind of nudge for collection, right? So that's your fallback mechanism. There obviously then, if that doesn't work, you have collection agencies, you have reminders that go out.
Integrate with third parties.
Exactly, all of those. So, but I would say those are, again, you're falling back on more conventional channels,
right?
But the core part is, how do you sort of estimate a lot of this, or you bake in a lot of this while you are giving, while you are underwriting the merchant. Yeah.
No, that's interesting. And in fact, if I look at it, right, if what Ajay is saying, what stuck my mind is, in the relationship management, especially the kind of relationship management he's talking about, the fleet on street guy knows the customer, knows the borrower, and there is a flexibility of payment when the borrower is not in a position to pay X EMI and then probably get converted by X by 2, right? That's how I hear it. And if I sort of try to bring in parallel example, Lazy Pay, for example, the BNPL, I think I was told, and in fact I was just checking it, they have this option, there's some 10,000 that you need to pay, but they give you an option, look, you can pay less, or you can reduce. Is that way forward for us when you talk about integrating giving the flexibility? Because what you pointed out, 99% of them are good and everyone wants to pay. What it means for us is 99% all of us want to pay. It means it's being rather more flexible and more understandable for them to pay back. And do we see such models evolving? From what you're talking about, definitely I rather anticipate that, because of course right now you're talking about still banking on the third parties. But what Ajay is talking about, quite interesting, because what they're doing is based on relationship management, what they're doing, which is the example that I quoted from Lazy Pay. And you're talking about the entire data of it, right? I think, do you see that this kind of digitalization being quite flexible when the customer does not or is not in a position to pay X EMI, and you want to make it flexible, and obviously the number of EMIs get extended, or the interest rate pops it up on the remaining amount. So do you see that's happening, or do you see that's going to be a challenging?
I'm extremely sorry to interrupt, sir, but the time is up.
Yeah, it's just last one. Yeah.
So
Winding up.
In a minute I'll wind up. So I think at the time of when you underwrite, this question is differently answered than once he's bounced, the answer is different.
Absolutely.
So the flexible products are available when you are telling me upfront, saying that, look, I need 6 months, or I need 9 months, or I need 12 months, or I need 2 years to pay this much money back. But once you have taken a contract with me saying that you will pay me back this money in 12 months' time, and then after that, if you are coming and renegotiating, it becomes restructuring. And then it goes into a very, very separate bucket segment, saying that, look, because generally speaking at a scale, especially for because their income is disrupted, okay? Leave COVID part out, because COVID was a disruption and people came back after 6 months and paid. But in a generalized good environment and thing, it is not a great thing to put that as a flexible options on the table for everyone. Then you don't know whether the delay is happening because you are restructuring, and you also send a message to the market saying that, look, you can restructure without any loss.
Of course.
So it is not right after collections in a good markets to do that piece. It is more, then it becomes a negotiation that, okay, you can't pay. So
not at the time of lending, but probably much at a later stage.
After that, see, if once is defaulted, then of course that negotiation is restructuring, not a flexibility. Yeah. Let me put it that way. He can't pay, that's why instead of 6, you are giving 12, but it's not you are not giving willingly. You are just the situation demands it to do it.
Got it. Got it.
No, I fully agree. I think the way to do it is then to build it in the product itself.
Absolutely.
So, for example, if you have a PL product, right, it's a fixed EMI, and then it goes down to restructuring. But let's say in some products, like where there's a cash flow based financing, like for example, there are now fintechs who are doing revenue based financing.
Right.
So there, your EMI is not fixed. It's linked to your revenue or rather cash flow that's coming in. It's a percentage of your cash flow.
Right.
So that kind of flexibility is built in the product itself.
Right.
Right? Subject to obviously you paying a certain floor, right? A certain minimum amount. So then that's how you've designed the product. But I think to Ashish's point, if the product is not structured that way and you're trying to, you then after the schedule has gone out, after dispersal has gone out, then you're trying to build in a lot of flexibility, it could give mixed signals. Right. And it could draw some kind of wrong behavior as well. So there you need to be careful about.
Yeah. Got it. I think thank you so much. I think we've got short of time, but one piece, great takeaway is that we know that about 10 million, blue collared ones keep joining into the formal economy, and double of that white collar joins into the every year crosses 21 years of age. That's one. And on the other side, we keep seeing the market volatility and people layoffs and firing and all of that. A lot of this is sort of impacted at the same time. There's so much scope, especially at the level where there's unbanked and the first-time borrowers, and there is volatility with so much of things happening. People losing jobs or the instability in many other things. But I think that is all together with the rush of or the great opportunity that India provides as far as a fintech ecosystem or the lending or is concerned. I think the need for something integrated where we keep the customer first at the same time, knowing them so closely. Like I though it's not digitalized, but what Ajay comes out saying, that relationship-based understanding and making sure that I'm helping them to pay better. I think we'll probably see how the digital revolution evolves that sort of a flexibility and that sort of keeping the customer first and making sure that the collection happens on time. I think with that note, thank you so much for all the panelists bringing in your experience and talking about. Thank you so much.
Thank you, gentlemen, for this insightful talk.